It is almost 1 p.m. in Sydney, 11 a.m. in Hong Kong. Welcome to Bloomberg Markets Asia. I'm Haidi Stroud-Watts. Here are your top stories. Asian shares are sliding as focus shifts from the Fed policy outlook to Nvidia's earnings this week. A growth warning from Pinduoduo weighing on regional e-commerce giants. BHP's full-year profit edges higher, even as China's uneven recovery drags on demand for iron ore. We'll be speaking live with the CEO, Mike Henry, in just a few minutes. Plus, LG Electronics reveals it's exploring an India IPO to capitalise on a market boom. We'll be hearing exclusively from the CEO, William Chobe. Let's get you straight to these markets. So with Avril Hong in Singapore. Avril.
Yeah, Heidi, we're seeing markets lower today, and this is the drag we're feeling from the tech space. You really get the sense that investors are really watching out for that one event today, Nvidia Earnings, later in the week, of course, and we're seeing how the trading volumes are lower than usual. It's this pre-Nvidia jitters they're getting. But the other key theme also is from Chinese companies' earnings, the likes of Pinduoduo, US-listed stock, erasing all the gains that we saw since October last year. 29% down. This is no thanks to its warnings about sales, and it missed on revenue. If you flip the board and take a look at this chart, you'll actually see how it has fared in terms of the stock price. So Chinese consumption weakness is a key theme. Let's bring in our Bloomberg M Life strategist, Mark Cranfield. Mark, we're just getting this reminder yet again about how weak Chinese consumption is for the tech space. How much further fallout should we be expecting?
Well, it could be the early stages, because we've seen one of the worrying trends, of course, is the consumer price index in China. It's been pretty close to zero for a long time. There's even talk that China might be going back into deflation, and that obviously is a reflection that people are not spending enough money in the country. And we've got the central bank, PBOC, is pushing very hard, probably need to lower interest rates yet again. They're very focused on the short-term rates, they're already down below 2%, but they may need to go lower still. They're going to get some assist here from the Federal Reserve, but it might be that we're into the stage where it's a bit too late, that the monetary policy easings are now coming when it's already hurting the consumer more than they can recover quickly. So if it affects one major Chinese company, people will obviously be extrapolating and think that any of the others could be at risk as well. So we're back into this fear of the interconnectedness of markets, where what happens in one place can spread across. And of course, even people in the United States might start to fear that even Nvidia may have something to worry about when they report later in the week.
Interconnectedness when it comes to the broader macro weakness in China as well, right? Industrial profits, that was kind of a flattering number, but it looks like things could get worse from here. And we're hearing that across a lot of the narrative this earnings season, right? Particularly when it comes to those quite exposed likes of BHP.
Yeah, it's partly also about expectations as well. If you think of where the global trends have been going, overall, it's been a pretty good year for equity markets globally, led by the United States and some parts of Asia and Europe as well. And yet here we are, we're coming towards the end of the year. We've got the Labor Day coming up in the United States as well. We've got the Fed rates coming, but it could be one of those situations where it's priced in. And people may now be starting to think, well, the Fed's already behind the curve. They can't do that much about it. And all these valuations which are priced into markets may be unjustified. And whether it's in the commodity space, whether it's in the tech space, even in the banking sector as well, people will be beginning to think that they've taken enough risk. Particularly with the US elections to come in a couple of months' time as well, it wouldn't be too surprising. And it often happens after Labor Day where people start to take money off the table. So we could be entering that period where no matter we get a boost from lower interest rates, it may be just too late and people don't want to take the risks anymore. Nvidia will be a very big factor this week. But even if it's a blowout move from them, it could well be that people just use it as a reason. There's so much money built up in that particular stock. People may just use it as a profit-taking situation. And we could go into next week in a completely different format.
Bloomberg M Life strategist Mark Cranfield there. Let's get some more on BHP and this issue of China, because full-year profit at BHP did edge up around 2%. That was broadly in line with analyst forecasts. But China's property crisis continuing to weigh on demand for iron ore. The world's biggest miner says it now expects near-term volatility in global commodity markets, with China facing an uneven recovery. CEO Mike Henry joins us now from Melbourne. Mike, really great to have you with us, and congratulations on the resilient numbers. You know, in light of what are some challenging circumstances circumstances, particularly when it comes to China. We were just talking about this idea of these risks, to what point they're being priced in by investors. And I do wonder, what level of weakness in the demand out of China are you pricing into your outlook?
Well, look, great to be here, Heidi. And let me start first and foremost with BHP as a long-term company. And you can see coming through our results this time around, this consistent year-in, year-out focus on operational excellence. And that's delivering industry-leading returns for the capital that we have deployed in the business. And we've revealed more this time to shareholders about the growth outlook for copper, which is an attractive commodity long-term. As the global population continues to grow, we see further urbanization and the decarbonization thematic plays out. Now, in the very near term, what are we seeing by way of economic growth? The overall global picture is one of 3% growth for the next couple of years, similar to last year. We are seeing some momentum build in a number of the major economies globally, and of course India is set to remain the fastest growing major economy. In China, a bit of a mixed picture. We're seeing strong growth in a number of segments that are important for commodity demand in China, and that includes automobiles, machinery, infrastructure, shipbuilding. But the property sector itself, which makes up about 20% of steel demand, that is weak. It's been weak for some time. We've seen lower or fairly low levels of both sales and new starts. But the Chinese government is enacting policies that are intended to address that. And that includes relaxing some of the constraints on property purchases. There's a government program underway to mop up some of the excess inventory. And we expect those to start to have effect through 2025. All of that paints a picture of us remaining of the view that China is going to be able to hit its 5% growth target for the year, assuming that the policies that they're enacting get carried through. Now, for iron ore, what does that mean? Another billion-ton plus year of steel demand, reasonably healthy iron ore demand, albeit under a little bit of pressure currently. And BHP is very well positioned in this market, given that we're the lowest cost supplier. We've stretched the lead on the cost front yet again this year. And we're achieving better pricing outcomes than the competition. So certainly well set, even for a bit of short-term weakness in the market. And at a portfolio level, the company is really well positioned for the future.
Do you see further production cuts as being inevitable in China? Because we did see losses for Chinese steel mills deepening again in the last month. And does that impact, your forecast in terms of demand going forward? Do you think we've hit a bottom for steel mills in China?
Yeah, so what we've said is that we think steel demand is plateauing or is plateaued around 1 billion tons plus. And of course, there's going to be a bit of variability within the tens of millions of tons in and around that. And that longer term, we do expect that steel demand, just like as the pattern that's played out in all major economies as they've developed, that over time, once an economy moves past its steel-intensive early development phase, it will become less steel-intensive, and we'll see a contraction in steel demand. And over time, that will weigh on iron ore demand as well. It's one of the reasons why we've worked so very hard to set the business up for a future of more heated competition. We've moved to the bottom end of the cost curve. We've maintained that position, and we've improved the quality of the product suite that we're offering as well. And that's giving us great returns in the business. Near term, we're seeing a bit of price pressure, but bounded on the downside by a lot of high-cost supply kind of sitting in the $80 to $100 per ton range. And it would take a lot for the market to push below that to prices that would be sustained at lower levels.
Where do you see prices then, I guess, falling in the more of the medium and the longer term?
So this is the high-cost bench that I've referred to. So you've got about 170 million tons of iron ore production globally that's higher cost and sitting in that $80 to $100 range, about 80% of that between $90 and $100. And so what that means is, where we see short-term volatility in iron ore demand, or even medium-term pressure on iron ore demand, that bench has to be worked through before prices would drop sustainably below those levels. Now, again, I'd come back to the fact that in all markets, in all cycles, BHP is very well positioned because we have an industry-leading cost position in iron ore and very good pricing being achieved for the products that we sell.
would you like to see more stimulus efforts out of Chinese policymakers? And I guess conversely to that, you've spoken about the importance of demand from India. Do you see that as being sort of a meaningful hedge to the weakness out of China?
It really depends on the commodities. So at a very high level, of course, we're seeing India, Southeast Asia continuing to grow. But the demand is the composition of that demand for imported commodities, at least, will be slightly different than it's been in China. Case in point would be India will be reliant upon importing of high-quality hard coking coal, less so on iron ore because they have domestic resources. In the case of China, they've been more dependent upon imported iron ore, less so on coking coal. So that will shift over time. But if I come back to China and your question about would we like to see further stimulus, we're believers in long-term fundamentals, and we have a lot of insight in this regard, and we believe that the fundamentals remain intact for China to continue its growth beyond kind of its middle-income status currently. They're obviously focusing on high-quality growth, and we expect that as they do continue to grow the economy, it's going to mean plateauing of steel over time, a constrained iron ore market, but increasing demand for some of the other commodities that we're focused on, including copper and potash. So if you look at the BHP growth story that we've laid out in, well, both in our strategy, but with some of the detail in this results presentation, it really is talking to all of the effort that we've had underway and the optionality that we're building up in the portfolio for those commodities that stand to benefit greatest from the ongoing trends that are playing out in the world around us, including in China.
I'm glad you brought up copper because it's, about a third now of the overall business, and you've said in the past that you expect demand to double. Do you still sort of stand by that forecast, and do you want more resources? How will you sort of make this forecast materialise?
So BHP starts in a great position. We're one of the world's largest copper producers already. We have the world's largest resource position in copper, and we see this as an attractive commodity longer term because the demand fundamentals are so strong. As the world's population continues to grow, as it urbanizes further, standards of living rise, and the energy transition unfolds, those are all copper intensive, and it's becoming harder and harder to bring on new supplies. So as an incumbent player with a large position and the best resources, the largest resources in the world, we're starting from a strong position. But of course, we need to be able to translate those resources into more valuable production. And that's really what we've spoken to in this presentation, is all of the effort that we've had underway in copper South Australia, in Chile, and more recently through a partnership that we've announced with Lundin Mining in Argentina. We've built up this wonderful portfolio of future options in copper, and now it's really incumbent upon us to prove those options up further, and then ultimately to use these resilient cash flows that we have, strong balance sheet, to invest in that growth for high returns for shareholders over time.
You've got 3 jurisdictions of Chile, Argentina, Australia, also in Arizona when it comes to these copper assets. Give us an idea of, I guess, how you manage, all of these different assets at this point.
Yeah, so let me start by saying it's a great challenge to have, that we do need to be quite thoughtful and deliberate about how we go about comparing those projects for best returns and risk profile, and then for staging them over time. Now, we have a capital allocation framework that we put in place in 2016. It stood us in good stead. In essence, what it does is it provides a framework within which we determine how best to allocate capital, and that includes our 50% minimum payout ratio in terms of returns, cash returns to shareholders, and then for excess capital, how we think about comparing between putting more to the balance sheet, investing in organic growth, looking at acquisition opportunities, and so on. And it's really through that framework that we'll take all of these options and options beyond that, including in potash, for example, to say how do we go about creating best value and returns for shareholders over time.
The bid for Anglo meant that you had to walk away for 6 months, so that takes us through to about November. Is the door truly closed there? Would you go back for another attempt?
I was at pains to say at the time of the proposed acquisition, which we thought was a great opportunity to create value for both sets of shareholders. They've elected to pursue their plan, and we're doing exactly what I called for at the time, which is that Plan A for BHP was never about acquisitions, and it wasn't about that specific opportunity. It was about everything that you see in this set of results, which is focusing first and foremost on ensuring that we're getting the most out of the capital that we already have deployed in the business, and it's this passion for operational excellence, which is giving us higher margins consistently and better returns for the capital that we have deployed in the competition. And then looking at how we go about investing in organic growth within this wonderful portfolio of resources that we have, with a specific focus on potash and on copper. And you see this, both Jansen Stage 1 and Stage 2 underway now. By the end of this decade, we'll be a major producer of potash. Those projects are going well, Stage 1 ahead of schedule. And in the case of copper, we've revealed more detail this time around about our plans for Escondida, the growth opportunity ahead for us in copper South Australia, and of course we recently went public with the accepted acquisition of Filo, which will go to a vote of their shareholders in due course.
You've spoken previously about this notion that perhaps wage inflation has plateaued, but clearly it is a big component to cost inflation. Indebtedness has also been on the rise as well. So can you give us an idea of sort of some of the cost pressures at this point and what the picture looks like in terms of, is that a limitation on resources when it comes to M&A activity?
So inflation has improved for many of the inputs into the business. There's a bit of a lag effect in the cost of labor. Having said that, in a world in which general inflation, inflationary headwinds for the business have been about 4% over the last year, we've held cost increases to 3%, and we're forecasting 2% increase in costs in the year ahead, and that is markedly better than our competitors when it comes to our ability to control costs. So we see it as incumbent on us in the face of those inflationary pressures to be focused even more sharply on how we go about working together with our workforce, using technology and so on to lift productivity in the underlying business. And you can see that success coming through again in the period past as it has in recent years. That, combined with the quality of the assets that we have, which are large assets at the low end of the cost curve, ensures that we're generating more consistent cash flows and higher margins than the competition. So we've had average margins of about 55% over the past decade. That's a full 10 percentage points higher than the competition. And net operating cash flow of above $15 billion per annum for the past 15 years, bar 1 year. And that gives us a resilience at all points in the cycle, and it allows us to fund in a balanced way both shareholder returns and investment in the growth in growing the business through the cycle.
Mike, really great to have you with us. We appreciate you spending time with us today. Mike Henry is the CEO of BHP, joining us from Melbourne. Still ahead, more earnings debriefs with CEOs of Australian companies, including Guzman y Gomez. Co-founder Stephen Marks joins us later this hour after the company's full-year guidance underwhelmed investors. Feeling some pain when it comes to that share price today. We'll also be speaking with Woodside Energy's Meg O'Neill about their profit beat. Another big interview coming up. Nvidia CEO Jensen Huang speaks exclusively to Bloomberg Television about their second quarter results drop. Our special coverage begins at 6:30 a.m. Thursday. If you're watching in Hong Kong, that's 6:30 Wednesday evening in New York. This is Bloomberg.
We will be introducing a 100% tariff on Chinese-made electric vehicles and a 25% tariff on Chinese steel and aluminum. But actors like China have chosen to give themselves an unfair advantage in the global marketplace.
Canadian Prime Minister Justin Trudeau, they're announcing new tariffs on Chinese-made electric vehicles, aluminium and steel, joining Western allies in taking steps to protect domestic manufacturers. For more, let's bring our China correspondent, Min Min Lo, who joins us in Hong Kong. So, Min Min, this is sort of the cohesive action we're seeing across Western allies, right? How extensive are these tariffs?
That's right. You just heard Justin Trudeau there saying that there will be 100% tariffs on Chinese EVs, 25% on steel. If that sounds familiar, it's because it's actually very similar to what the Biden administration had announced a couple months back on the tariff rates for those exact products as well. The Canadian tariffs will target not just fully electric vehicles, but also certain types of hybrid vehicles, trucks, delivery vans, buses. It's a preemptive move because Chinese producers don't have a lot of foothold in the Canadian market just yet. And the Canadian government is also looking to limit the consumer incentives for EVs to those vehicles that are produced within countries that have a free trade agreement with Canada. Obviously, China is not on that list. And aside from the steel tariffs, Canada is also opening up another 30-day consultation period to look into potential tariffs into other products, including solar products as well as critical minerals, batteries, battery parts, semiconductors. So potentially a whole new wall of tariffs that are targeted at Chinese producers here.
Min Min, to Heidi's point, we are seeing this concerted effort by Western allies on Chinese EVs. The EU also looks like it's proposing some of these tariffs, though at lower rates than the US and Canada. What is the overall impact on the Chinese EV industry likely to be?
Yeah, so the Canadian tariffs at least. So last year, if you look at the trade numbers, China exported about $1.6 billion worth of EVs to Canada, but the bulk of that are Teslas that are made in Shanghai's Gigafactory. So what's going to happen is likely that Tesla will shift its production maybe away from Shanghai to America to export to Canada. As for the Chinese brands, we have BYD that was specifically looking at entering the Canadian market. In fact, in July, they had just informed the Canadian government of their intention to lobby officials to let them enter the market. So those plans might be dashed now because the math may not really work out in BYD's favor. And BYD also entered into that agreement with Uber to put 100,000 of their cars on the ride-hailing platform, starting with the EU market and then eventually expanding to other markets, including Canada. So that could be on shaky grounds as well. But we do know that BYD does have a big foothold in Mexico, where they plan to build a plant there as well. So could Mexico be that final foothold for these Chinese producers to enter the North American market? Because remember, Canada, America, Mexico have a free trade agreement, and that is why Canada was under pressure from the US to really close that loophole to ensure that Chinese producers cannot enter America via Canada. Mexico is also under pressure from the US as well to align its trade policy on China, but we'll have to see whether Mexico will also roll out similar tariffs here. But for now, BYD is saying they are not planning to export from their plant in Mexico.
Bloomberg's China correspondent Min Min Lo there with the details. More ahead, this is Bloomberg. Take a look at some of the stocks that we're watching when it comes to the Aussie session. Really some directional challenges there when it comes to the downside they're being felt for Johns Lyng Group. This is the construction services company. Sales revenue forecast falling short of the average estimate. We're seeing that plunge of actually at about 25%, actually much less than what we saw earlier, which was as much as 33%, the most on record. They are guiding to higher business as usual margin in full year 2025 compared to expectations, but certainly there's some disappointment there when it comes to the extent of revenue growth that's being implied by that guidance, as according to analysts for Citi. They're seeing that sales revenue at 1.13 billion Aussie for the 2025 forecast, so quite a bit less than the expectations. We're also watching BHP, of course, as we were just speaking to the CEO, Mike Henry. He sees that copper surplus in the short term, as well as the potential unevenness of that China recovery, even as profit sort of stays pretty resilient. Coming up, more market analysis. Aberdeen's Deputy Head of Asia Pacific Equities. Take a listen to why they think a risk-off sentiment could soon prevail in these markets. This is Bloomberg. Take a look at China markets just headed out to lunch, and it has been quite a few sort of divergent stories there. Certainly some of the tech names being dragged lower. Of course, we had quite a bit of disappointment when it comes to Pinduoduo. Really less about the numbers perhaps, which were disappointing, but perhaps not to the extent that we've seen that sell-off, but really some of the warnings when it comes to the competition ahead and the sustainability of PDD or Temu's growth trajectory. We are seeing the likes of Trip.com, the shares rising in Hong Kong after a beat on second quarter earnings. So very much about the earnings flow for the story today. And we are seeing just broader concerns about whether or not we're seeing Chinese consumers and spending kind of tapped out as a result of that record plunge that we see expressed in e-commerce giant PDD Holdings. Broadly, we're seeing the CSI 300 off by just about 0.6%. A little bit less weakness there when it comes to trading in the Shanghai Comp and some of those sort of tech components, particularly when it comes to trading in Shenzhen, seeing a little bit more of a lag. And of course, as we wait to get the Fed's preferred gauge of inflation later on this week as well, we'll be watching to see whether that kind of changes the trajectory for the scale of easing expected from the Fed and whether that moves the direction of the dollar. Dollar yuan at this point holding pretty steady, but the PBOC obviously has been sort of making some effort to that end as well, Avril.
Yeah, certainly. I mean, when it comes to Asia Tech, it's getting a bit of a double whammy on the Asia Info Tech gauge today on the backdrop of what we're seeing from the narrative of weak Chinese consumption, but also as investors look out to those Nvidia earnings later in the week. And as one Nomura analyst put it, the markets in Japan, at least on what we're seeing on the Nikkei, lower trading volumes, but it's also a mix of buyers and sellers ahead of that earnings report. In terms of what we're seeing in the rest of the broader benchmark, the topics are showing a bit of green, perhaps also helped along by what we're seeing in the Japanese currency, returning a bit of the gains that we saw from Friday. But we are also in the midst of the earnings season on the MSCI Asia Pacific, 3/4 of the way through thereabouts. We've seen more beats than misses, particularly among utilities, tech, and healthcare. And if you flip the board, I'll show you as well, in terms of stock market performance, we've also seen tech as well as the dividend-heavy financials. Those are the best performance year to date in this part of the world. I want to focus on tech first. Let's bring in our markets guest who has the tech sector as one of her top conviction calls. She's Pruksa Ayamthongthong, Deputy Head of APAC Equities at Aberdeen. She joins us from Singapore. So Pruksa, when we look at tech, headwinds abound, even though there's still a lot of optimism on the sector. This week, we're seeing a bit of a rotation out of it because of the expectations of Fed rate cuts, but also those Nvidia earnings. What do you think is the key driver in the short term?
I think the key driver in the short term and actually the long term for tech remains the growth of AI. And I think if you look at the way that when we talk about earnings within tech, what remains quite clear is that earnings related to the growth of AI remains pretty strong, while those that are more leveraged to the non-AI recovery remains to be a bit weaker than expected. So I think AI is still very much the key, and Nvidia results will also be the last piece of the puzzle that the market's looking for, because earlier on we have the results of the hyperscalers, and when you look at the commentaries and the guidance, they are all pretty positive on the capex that they are spending and the returns that they are starting to see from AI as well. So I think the market might be a bit skeptical now. There's a lot of factors, but we are looking really whether there is going to be continued sustainability of the AI trade.
I want to pick up on your point on the hyperscalers in a bit, but also bring you the question about the question of the day from our MLive team. How much do you think the stocks will rally in the wake of Nvidia earnings? I mean, we see how it is an outsized role in US stock markets.
I think it depends on a few factors, but most important is really about Nvidia assuring the market that the demand in terms of AI continues to be pretty strong. And I think whether that will be in line with the comments of the hyperscalers that have been supportive so far. The other important thing that we are watching out for within Nvidia is really with regard to earlier on there is some noises with regard to the delay that they have in one of the Blackwell chips, and whether the delay is going to be pushed back further than the market has expected, and therefore pushing back the AI trade. So this is something that's important. And again, it all comes back to the sustainability of AI growth.
What are you looking at specifically in the AI infrastructure complex? I mean, apart from some of the chip names, how much further room to run do you think these hyperscalers as well have?
When we talk about the way that we have accessed the growth of AI within Asia, it really boils down to the supply chain and pick and shovels, if you like, in the enablers of AI. So when you look at the valuation, and I think we have been through a very volatile month in August as well as late July as well for Asia Tech. So valuation actually doesn't look stretched, especially post the correction. What's more important is really that the demand stays robust, and something that the market has been having a bit more of skepticism, but we are positive on the sustainability of AI. I've just came back from Taiwan not too long ago, and based on the conversations that we have within the supply chain, we do think that fundamentals remain pretty much intact, but I think the market has just been very volatile on various factors.
What about on Chinese tech, Pruksa? I mean, we get this weak Chinese consumption narrative just coming through, another reminder from the likes of Pinduoduo earnings. Do you think among the Hong Kong listed names that these share buybacks is going to help to offset the broader concerns?
I think we have to separate the two. I think Chinese consumption remains to be weak, and recovery is going to take a more gradual stance within the Chinese consumption. But if you look at the way that the earnings have come out, not all consumption is weak. It is still very selective. So there are categories that people are still spending with regard to, for example, travel. The spending there remains quite robust as well, but elsewhere is to be pretty weak. So I think we just got to be selective about the kind of exposure and leverage ourselves to the growth categories where it's registering growth above the average consumption. In terms of share buybacks, we see that as positive news, and we are seeing increasing signs of better progressive share buybacks as well as dividend payment and better care for shareholders' return. So that will help to also provide a bit of stabilization to the share price of the Chinese consumption names and China internet names as well.
You have India as well as part of your conviction calls. I mean, how much of this is just China alternative as an investment play?
There'll probably be some of that. I wouldn't say it's just a China alternative. I think if you look from a broader Asia perspective and you think about where the earnings visibilities have been, it's actually largely in tech and largely in India. So it's really the market that's paying up for better earnings visibility. And that is something that we continue to see in India, and in many parts of the sectors is still at a recovery phase. So I think India is expensive, but it is rightly so because of better earnings visibility relative to the rest of the region.
What other parts of the region do you think will benefit from that expectation of Fed rate cuts, barring, of course, if we do see an outsized one in September and those concerns about, further weakness in the Chinese economy, or the US economy, I should say, more than expected?
So apart from the North Asia economies that I've talked about, I think broadly where markets have been pretty weak and currencies have been quite weak have been in ASEAN. So places like Vietnam could be one where you could see more flows back into the frontier markets. And I think from a fundamental perspective, when we think about the way that trade has been moving as well, supply chain diversification, Vietnam remains to be a very attractive place over the long term.
All right, Pruksa, thank you for sharing your strategy with us. Pruksa Ayam Tong Tong of Aberdeen. Haidi?
And of course, overall, one of the big reasons we're seeing risk aversion in the session is really ahead of this big story, Nvidia's earnings. And we have that big interview coming up with the CEO, Jensen Huang, speaking exclusively to Bloomberg Television. Our special coverage begins at 6:30 a.m. Thursday in Hong Kong. That's 6:30 Wednesday evening in New York. Well, LG Electronics is considering an IPO for its India business to tap a booming stock market as it targets $75 billion annual revenue by 2030. Bloomberg spoke exclusively in Seoul with the CEO, William Cho, to discuss the electronic giant's global outlook.
On top of our major market like North America, Europe, and Korea, we see a lot of potential, growth potential in other emerging markets like India and Latin America and Middle East. So let me take an example of an Indian market. In India, we boast #1 market share in every single product. So as you know, India is one of the fastest growing markets in the world. And the India will be continue to be a key market for our growth. But it's not about just the product sales. We aim to be the national brand in India. So as a company who have grown and loved by Indian people, we understand we should grow with Indian people. And providing the product and solution which will make eventually their life better. And for the IPO, yeah, I understand there's increased interest in Indian market among global investors. And
especially with Hyundai's successful Indian IPO as well.
Yeah, we follow all the IPO events of the other companies. Yeah. It is, yes, increased interest, but as of now, nothing is confirmed.
But it's being considered?
It is one of the many multiple options we can consider. Nothing is not yet confirmed.
Are there any other growth markets that you're targeting? You've mentioned India, you've mentioned Latin America, the Middle East as well. What do markets like China look like given the economic uncertainty there?
Chinese market is hyper competitive due to the multiple players in China. I think they are struggling with the shrinking demand in China. That made the competition even more severe. So for the time being, we do have some presence through the online businesses. We are in kind of status in wait and see for now.
LG Electronics CEO William Cho there speaking exclusively to my Asia Trade co-anchor Sherian in Seoul. Coming up, our interview with Guzman Y Gomez co-CEO Stephen Marks will be talking about the fast food chain's first earnings report after their blockbuster listing in Sydney. That's next. This is Bloomberg. Shares of Guzman Y Gomez fell in Sydney after the Mexican-themed fast food chain reiterated its full-year guidance. Disappointed investors were betting on an upsized outlook following the stock's blockbuster debut. The company reported pro forma net profit after tax that was up 94% on year. Joining us from Sydney now is the founder and co-CEO Stephen Marks. And Stephen, I've got to congratulate you on some pretty resilient results, and hopefully there's more to come. But investors were disappointed.
Well, we weren't disappointed. I think, since our listing, the team here at GYG, we're very focused on making sure that we execute, our strategy at GYG, and that's serving hot, fresh, delicious food, at speed. And obviously you can do it, dine in, take away through our app, drive through delivery aggregators. And obviously we're very proud of the results we had for FY24.
So clearly a part of this is just supersized expectations, right? But why did you stick to guidance?
Well, for us, what's really important, we're off to a good start of the year. and it's just important for us just to focus on what we do day by day and making sure we're in our restaurants, making sure our franchisees supported, and you know, GYG is a generational business, and we don't really look at the markets. We just stay focused on what we can control, and that's just making sure that, you know, we take great care of our guests and our food is hot and fresh, and we let the market take care of itself.
We've seen quite a bit of downside when it comes to trading in Collins Foods. Obviously, they operate the likes of KFC, also pressure on Domino's Pizza. And it's been on both sides, right, when it comes to rising operational costs, inflation, but also rising cost of living and the demand side as well. Do you see your business as being somewhat immune to these pressures, or are you feeling this as well?
No, for us, you know, everybody talks about that. I mean, the big difference is food, right? We're a food business, and you know, and GYG's food, it's clean, it's hot, it's fresh, it's healthy. You know, we spend a lot of time, obviously, in our restaurants. You know, we have a very young demographic comes in. I mean, they're kids. You know, they're 18 to 35. You know, in a market like this, people are trading down from restaurants to fast food. They're just very discerning which fast food they want to go to. You know, and the mission at GYG is to reinvent fast food and change the way the masses eat. And what GYG has on offering is real clean food, and our guests love it. And obviously you can see that in our results.
Does that mean you think your business is also Ozempic proof?
Well, you know, it's funny that you bring that up. I mean, I've been asked that question several times. If hopefully one day I can take you through one of our restaurants. I mean, what GYG has created is one of the fastest fresh food operating platforms there is. So you can have a regular size burrito, or you can have a mini. You can have a regular bowl, or you can have a mini bowl. You can have a regular nachos, or have a mini nachos. You know, and our view is that, you know, we want to make sure we have something for everyone. So if you want to eat a little bit less, GYG has that on offer. Where a lot of other restaurant companies, they usually have a linear setup. They only serve one size. So for GYG, you know, we're selling more and more mini bowls, and people still have to eat, right? And we just want to make sure we have the portion size for them. I mean, I've had mini bowls probably for the last 5 years. I just had one. I just had a beautiful spicy chicken bowl with brown rice, fresh guacamole, a couple corn chips. It was enough. So I think, you know, I mean, if that's the way the diet trends go forward, GYG's got you covered.
Well, that's clearly fueled, you know, giving you the energy needs that you need for this interview, right? But I do wonder about sort of expansion ambitions. We've heard reporting that you wanted to add 30 stores within Australia this financial year. Can you tell us a little bit about if you're on track for that? What about beyond Australia? What's your market focused at this point?
Yeah, so for FY25, we're definitely on track for those 30 restaurants. We have an incredible real estate team. And as we always say at GYG, there's three things we'll never compromise on. It's food, quality, our people, and our real estate. So, you know, obviously we have a lot of drive-thrus that GYG operates. Those take about 2 years to open. So, I mean, so our pipeline is 2 years locked in. So we're very confident on reaching the 30 number. We've got great partners in Singapore and Japan that continue to do well. So our main focus is on Australia and now on the U.S. We have 4 restaurants in the suburbs of Chicago. We'll get that up to about 15. But until we prove concept there, which means AUVs of about $3 million US, which for us, we feel like that will enable us to have underlying economics like we have in Australia. But till we get to that point, and it'll take time, like it took time to build Guzman y Gomez here in Australia, but when we get to that point, then we'll look to expand. But it's going to take some time.
Are you looking at emerging markets like Greater China or India?
No, I mean, from day one at GYG, we focus very well, and those are the markets that we're in, and those are the markets that will grow at this time.
Does New Zealand make sense, though, as a next step?
Yeah, New Zealand, I mean, I love New Zealand. It's one of my favorite countries in the world. But as of today, I mean, our focus is on Australia, Singapore, Japan, and the U.S. only.
What do you think the greatest risks are? So you sound very bullish, clearly, and you know, as you should be. But what do you think the biggest risks are to your outlook?
Have you dined at GYG?
The King's Cross story is our local, I have to say. But you know, I'm asking you, what do you think? You know, you've got to think on both sides of the equation, right? What do you think the risks are at this point?
Well, the risk for us is always we run restaurants, right? We want to make sure the food is hot and fresh, that it's safe to serve our guests, you know. And for us, you know, we don't really see any risk. You know, I mean, we think what GYG has on offer really, you know, resonates with the generation that wants this to be their fast food. So we just want to make sure that our pipeline continues to grow. We open up the stores that we say we're going to open. You know, our restaurants continue to obviously grow in revenue and profitability.
you view the broader sort of household sentiment issue in Australia? Do you anticipate that's going to hold up? Do you think there might be further disappointment for investors? I mean, do you look at what's happened to the share price today, and does that tell you that perhaps expectations were just set up so high against the backdrop of, economic uncertainty when you guys IPO'd?
No, I mean, in all honesty, we don't look at the share price. We're going to be in this business for a very, very long time. As I said earlier, we focus on what we can control. What I see a lot of is, a lot of people are trading down from obviously restaurants into fast food. And like I said earlier, they're just picking the fast food that they want. And we're very happy that it's GYG.
Stephen, really great to have you with us. Stephen Marks of Guzman y Gomez there as we continue to watch that stock throughout the course of the day. Of course, those numbers coming through this morning. Let's take a look at our Indian markets as we get into the start of the trading day there, and certainly not a strong lead as we get from the rest of Asia. A lot of those tech names dragging overall sentiment lower. Of course, Nvidia is the big one that we're waiting for. But as always, as often, we see that sort of decorrelation when it comes to performance in India. The Sensex is looking pretty flat, but still holding its head above water. This sort of world-beating rally, right? Extremely expensive compared to peers, but it does seem like most analysts we speak to are still very, very constructive. The Nifty 50 approaching that record high, but there's a lot of peakiness when it comes to valuations there. The India really kind of sticking out above and beyond even some of the valuations that we see in the tech-heavy markets like Taiwan. More ahead, this is Bloomberg.
Technology, there's still a lot of structural tailwinds for the sector, but it became a bit overdone in terms of stock performance. Again, the bar is high with the stock already up quite a bit off the lows coming into earnings. I think that's why investors are cautious going into their Wednesday numbers.
So we don't see that much upside at the index level. Valuations are fairly full. I think the economy and nominal growth outlook will drive stocks higher, but given where we are from a current valuation perspective, we don't see that much.
That's clearly not the case with the NASDAQ. In fact, if you look at the NASDAQ, it does seem, I'm not saying rolling over, but it does seem to be stabilizing at these levels. And I think, again, this speaks to the shift from growth to value. The expectations as embedded in price earnings multiples, I think, need to be balanced out, frankly, before we get to some sense of normality.
Some of our guests' views on how markets may react to Nvidia's highly anticipated earnings report coming up this week. And everyone, that's really sort of the core of what we've been asking our guests, right? What happens after these earnings? How much further upside could we see the broader market rally, depending on what we get from Nvidia? And, is this sort of Mag 7 AI-related rally still intact now that, of course, there is that sort of wider sigh of relief, knowing that the Fed is going to begin easing, despite still sort of questioning the nuance of that, right? The scale and magnitude of that path ahead.
Absolutely. I think the Fed has kind of taken a bit of the uncertainty in the tech equation out of the way, and now it's up to Nvidia's earnings to deliver. But as we've seen time and again, it has a knack for meeting already high expectations. It's had a string where its net income has just beat already lofty estimates. And indeed, that's going to be key to watch, Heidi.
It's really a single company that's moved broader stocks, perhaps like no company has ever done so before, right? Just intense focus on Nvidia, perhaps the most significant market catalyst still. We'll be hearing from the CEO, Jensen Huang. He'll be speaking exclusively to Bloomberg Television with that special coverage. 6:30 a.m. Thursday in Hong Kong, 6:30 in the